Listen up, if you start investing right now, you could turn $1,000 into $10,000 or even $100,000 before you hit 30. Forget about what you've heard about investing as a teenager, forget the BS about needing to be rich to start, and definitely forget about waiting until you're older. This is about understanding how money works and using it to your advantage. At 16, I invested my first $50 and now I'm on the path to financial freedom. So in this video, I'll reveal secrets most adults don't even know, and I'll show you why everything you've been told about saving is wrong and expose those traps that keep people broke. This is about freedom and building the life that you want. So if you're ready to learn how the wealthy really build their fortunes and how you can start doing it right now, keep watching and your future self will thank you. Let's kick things off with the most crucial advantage that you have right now, and that is time. But before we dive in, I want you to know that later in this video, I'll be talking about specific investment options like index funds and ETFs, and these are the perfect vehicles to put this power of early investing into action. So keep that in mind as we explore this concept and other concepts in this video. Compound interest is like a superpower for early investors, and the earlier that you start, the more powerful it becomes. Here's what I mean. Imagine that you have a magic penny that doubles in value every single day. On day 1, the penny is worth 1 cent. So on day 2, you have 2 cents. So it's not very exciting, right? But check this out. By day 10, this magic penny would have turned into $5.12. By day 20, it would have turned to $5,242.88. And by day 30, it would be worth $5,368,709.12. And that's the power of compounding. It starts slow, but it snowballs into something massive. Now let's make this more real for you. Say you invest $1,000 today and add $100 every single month for the next 40 years, assuming an average annual return of 7%, you'd end up with around about $260,000. If you just wait 10 years to start, you'd only have about $120,000. So think of it like this. Compound interest is like a rolling snowball down a hill. The earlier you start, which could be higher up the hill you are, the more time your snowball has to pick up speed. And by the time you reach the bottom, which would be your retirement, your snowball could be massive. And it's not about having a lot of money to invest. It's about consistently investing whatever you can as early as you can. And even $20 a week can grow in a significant amount over time. So remember, every day you wait is a day of potential growth lost. So start now, even if it's small, your future self will thank you for it, I promise. The next one is mindset shift, and you need to invest in yourself. Now, before we dive into stocks and savings accounts, let's talk about the most important investment that you can make today, and that is yourself. When you're just starting out, developing a high income skill is your fast track to wealth. Whether it's coding, digital marketing, starting a YouTube channel, a software company, these skills can pay massive dividends for years to come. And at this stage, my rule is this: allocate 70% of your available funds to skill development and then 30% to savings and traditional investments. And this might sound contradictory to what I'm about to tell you about the 40% savings rule, but stick with me. You're not just investing money, you're investing your earning power. The skills that you build now could lead to 6-figure jobs or even $1 million businesses down the road. And that's when the game changes. As your income grows, your skills become more developed. It's time to then shift gears. And this is where a 40% rule comes in, which I'm going to speak to you about. So next, I'm about to drop some knowledge that most financial gurus won't even tell you. And this is about building a foundation that will set you up for life. So first thing is get a bank account. I'm not talking some crap about account with hidden fees and all this sort of stuff. If you can find one with 0 fees and a solid online banking system, then this is your command center. Don't slack on this. It's an easy thing to do. Next, budget like your life depends on it, because financially it does. Use Mint or YNAB if you need to. I don't care how you do it. Just track every single dollar that comes in and out and know your cash flow like the back of your hand. And now here's where it actually gets real. We're going to talk about saving money, but not in a format that's save what's left at the end of the month sort of way. We're talking about the 40% rule. Now let's break it down with real numbers to help you understand. When I started, I was making around about $1,000 a month, and here's how it looked. I would earn $1,000 gross income. 400 goes straight to the savings and investments. 200 of that, 20% of that 1,000, goes to taxes, and then I'm left with $400 for living expenses. Yeah, so living on $400 a month was tough, and it is extremely difficult. But here's the thing, it lit a fire under my ass, and I knew I had to make more money. And that $400 I was saving every month, well, that became seed money for my agency. Now let's fast forward. Let's say you've now grown your income to $10,000 a month. And by the way, I'll have a video on my YouTube channel where you can learn to do so. But here's how that formula applies to $10,000 a month, but with a higher tax rate, of course, because unfortunately, that's how the real world works. $10,000 gross income, which means 40% of that, which is $4,000, goes straight into savings and investments now. Then $4,000, which is 40% of the $10,000, goes straight to the tax man. And then you're left with $2,000 for living expenses. Now, I know what you're thinking, wait, I'm making 10 times more, but I only have 5 times more to live on. Welcome to the real world of higher tax brackets. But look at the bigger picture. You're now saving $4,000 a month, and that's 4 times my entire starting income. And this is why this formula is so powerful, because it forces you to live below your means at first, which then pushes you to increase your income. But as your income grows, so does the amount you're saving and the amount that you're investing. And yeah, your taxes do go up too, but that's a good problem to have. And when you commit to saving 40%, 2 things happen. Firstly, you're forced to live below your means. You'll get super creative, and you'll realize how much of your spending is just mindless consumption. And secondly, you'll be motivated to earn more. And when you're saving such a big chunk, you'll naturally just want to increase that income. And you'll start hustling harder, looking for side gigs, developing high income skills. If you're really going to struggle with this, you can start with what you can, even if it's just 5%. But keep pushing that number up every single chance that you get. And the goal is always to be increasing that percentage up to 40%. And here's the key. When you're first starting out, focus on building those high income skills like I've told you. And as your income grows, gradually shift towards the 40% savings rule. And your goal is to reach a point where you're saving 40% of your income for investments while continually improving your skills. And before we move on, don't forget an emergency fund. Aim for 3 to 6 months of expenses, and this should shield you against any life's curveballs. Without it, one bad break would wipe all your progress out completely. Look, this isn't going to be comfortable, but it's not supposed to be. But neither is being 40 years old and still living paycheck to paycheck. Choose your struggle. Remember, you can't invest what you don't have. And that 40% you're saving, that's not just sitting there, and that's fuel for your investments, which we're going to talk about next. So master this, and you're already ahead of 99% of your friends. The game is yours to win. Now go and make it happen with this rule. All right, now we're getting to the exciting part, the stock market. This is where your money starts working for you. And for beginners, I always recommend starting with index funds or ETFs. These are baskets of stocks that give you instant diversification. So instead of trying to nitpick individual winning stocks, you're basically betting on the overall growth of the market or a specific sector. So diversification is key here, and it's like not putting all your eggs in one basket. By spreading this investment across different companies and sectors using index funds or ETFs, you're basically reducing that risk. When you're starting out, consider broad market index funds that track something like the S&P 500, and these give you exposure to 500 of the largest US companies in one investment. But here's a crucial point that most people miss. Make sure you're investing in an accumulation fund. So let me break this down for you. There are 2 types of funds: income funds and accumulation funds. Income funds pay out dividends to investors regularly. And that sounds good, right? But actually, in this scenario, that would be wrong. Every time you get a dividend payment, that's money that's no longer working for you in the market. Whereas accumulation funds, on the other hand, automatically reinvest those dividends back into the fund. And this is where the magic of compounding that I mentioned earlier actually happens. Your returns are earning returns, which are earning more returns, and it's like a snowball rolling down the hill, getting bigger and bigger. So here's an example for you. Let's say you invest $1,000 in the S&P 500 index fund. With an income fund, you might get $20 in dividends payout to you each year. It's a nice little bonus, right? But with an accumulation fund, that $20 gets reinvested, buying you more shares of the fund. Next year, you're earning returns on $1,020 instead of $1,000, and it keeps building from there. And over time, this difference can be massive. We're talking potentially tens of thousands of dollars over a few decades. And that's why when you're young and investing for the long term, accumulation funds are the way to go. As you learn more, you can then start exploring different sector-specific ETFs or even individual stocks. But remember, individual stock picking is much riskier and requires a lot more research and knowledge. For now, stick with the broad market accumulation funds and let compound interest do its thing. And this is how you set yourself up for long-term wealth building. You're not just saving money, you're putting it to work in the most efficient way possible. Now let's talk about another powerful strategy that goes hand in hand with accumulation funds, and that's dollar cost averaging. So here's the deal. The stock market goes up and it goes down all the time, and it's like a complete roller coaster. And just like a roller coaster, trying to find the perfect moment to jump onto a roller coaster while it was moving is nearly impossible. So that's where dollar cost averaging comes in. Instead of trying to time the market, you invest a fixed amount of money at regular intervals, and it could be $50 every week or $200 every month. Whatever you can consistently afford, that's fine. Here's why it's so powerful is when the market is down, your fixed amount buys shares, and it's like everything is on sale. And when the market is up, you're buying fewer shares, but the ones you already own are worth more now. So over time, this strategy tends to lower your average cost per share, and you're basically smoothing out those market ups and downs. So it makes life a lot better for you. Let me break it down with an easy, simple example. Let's say you decide to invest $100 every month in an S&P 500 accumulation fund. In January, the price per share is $10, so you buy 10 shares. In February, the price drops to $8, so your $100 gets you 12.5 shares. Stick with me here. And in March, it goes up to $12, so you only get 8.33 shares in that month. After 3 months, you've invested $300 and you have 30.83 shares in total. So your average cost per share is actually $9.73. Even though the actual share price fluctuated between $8 and $12, this strategy takes the emotion out of investing. You're not trying to guess whether the market is at a peak or at a trough. You're just consistently putting money in regardless of what the market is doing. So combine this with an accumulation fund and you've got a powerful 1-2 punch. You're consistently buying it at an average price, and then you're reinvesting all your dividends to buy even more shares. And this is how you build wealth over the long term. You're not trying to get rich quick. You're setting up a system that consistently grows your wealth over time, regardless of what the market does in the short term. Remember, investing isn't about time in the market, it's about time in the market. Dollar cost averaging ensures that you're in the market consistently, maximizing your time and minimizing that risk. All right, let's talk about what not to do, and I'll cover this really quickly. First, avoid get rich quick schemes. If something sounds too good to be true, it probably is. Those guaranteed 100% returns, well, they don't exist in the stock market. So make sure you don't fall into that trap. Secondly, don't overtrade. It's tempting to constantly buy and sell stocks, trying to time the market, but study after study shows that this strategy usually leads to lower returns. So remember, investing is a long-term game. And so there you have it, guys. That's how you actually invest as a teenager. And remember, the most important step is to just start. You don't need a lot of money. You don't need to know everything. And you just need to begin. So there you have it. If you found this video helpful, hit the like button and subscribe for more content like this, and drop a comment below letting me know what you're going to invest in first. Until next time, keep grinding, keep investing in yourself, and we'll see each other soon.